I appreciate the position that investors find themselves in, but this is a tale as old as CMBS. This has been the case forever. It's nothing new. I just think it's a little more poignant right now.
Welcome to the TreppWire Podcast, the show where commercial real estate meets data and insights. This is a special guest podcast. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Lonnie Hendry, Chief Product Officer. Today, we're joined by David Harrison, Chief Operating Officer and Head of Special Servicing at Midland Loan Services, a PNC real estate business. As COO, David oversees operational performance, risk management, and strategic execution across Midland's servicing platform. In his role as head of special servicing, he leads the team responsible for the workout, restructuring, and resolution of complex and distressed commercial real estate loans and REO assets. David works closely with institutional clients, rating agencies, and regulators, giving him a real-time view into how stress, extensions, and resolutions are playing out across today's market. He brings deep experience across credit, servicing, asset management, and workouts, with prior roles at Fitch Ratings, KeyBank, and the Archon Group. David, we are so excited to have you here today. Welcome to the TreppWire Podcast.
Thank you. It's great to be here. Thanks for having me.
So we start almost every interview the same, but we'd love for you to expand on your background that I just said. Talk to us about how you got your start in commercial real estate finance and then what led you to your role at Midland.
Sure. Yeah. So it's a very, I think, non-standard path. I graduated from the University of Houston in the late 90s with a degree in political science and a minor in economics. My immediate aspirations were to go to law school, but I accidentally started working and making money and decided maybe I wanted to do that instead of going to law school. So I worked for an executive search firm, and one of the first assignments that we were put on was with the Archon Group. And I met the HR team there and ended up talking my way into a job with the Archon Group. So I started in their analyst training program. And for those who don't know, the Archon Group is effectively a group of Goldman Sachs. It was doing commercial real estate investments for them. So I started in CRE through that credit asset management perspective and did that until the early 2000s. When I got into Fitch. And at Fitch, I was fortunate to work with Bob Vercoda and the CMBS New Deal rating team. And, it was a busy time for CMBS growth and kind of the expansion of those facilities. So worked in that for basically until the great financial crisis, until 2009, when I got into servicing. And my wife was originally from Kansas City, so we moved to Kansas City. I started with Key in the special servicing group, and then fairly quickly moved over to Midland, where I've been for going on 17 years now. So I think the unique thing about my path is it's always been close to the intersection of credit and judgment and structure and execution. And specifically at Midland, my role combines kind of the macro responsibilities around operational performance and controls and client execution, and along with that focus on special servicing now. So my path is a little non-standard. I would really frame it as less of a straight line and more of a series of adjacent seats around the same table of commercial real estate finance.
It's interesting, David. We start off every guest show with that question, and I think we've only had one person that was basically born into a CRE family. Everyone else has a similar story where
Right.
they thought they were going to do something else. They had visions of being someone else, and then CRE kind of got in their blood. And I think for you, it's interesting. You wanted to go to law school, but the world you live in now is very similar. You're dealing with covenants, you're dealing with, contractual terms, you're dealing with execution and all of these things that are very similar. So maybe that's why you've been drawn to it and so successful at it. So talk a little bit about servicing. So before we get into the nuts and bolts and kind of the meat of the discussion, for our listeners out there that maybe have heard us talk about servicing or hear the term commentary or servicer commentary or property that's gone delinquent, just give us a high level overview of what servicing is, where it sits in the ecosystem, and then we can jump into a deep dive from there.
Yep, sure. So I would almost frame it as a misconception about servicing. Is probably one of the basic assumptions is that it's really just something that's administrative, right? That some money comes in, it gets passed on to, investors or the lender if it's a non-securitized deal, and that it's really just an administrative process. But whether you're in a more stressed environment like we are today, or a typical performing environment, I think that's a misconception, because servicing is really where a lot of factors come together, right? It's structure, it's credit, it's legal, it's operations, it's investors, it's borrowers, it's control issues. They all converge, right? So optically, sure, it's a loan. It's 100 loans in a securitization. There's a expected schedule of payments and a process to manage that money. And then there's also the interaction with the borrowers, right? I mean, the borrowers are running their business vis-a-vis the real estate. So there's leases to be done. There's amendments to be done. There's tenants that go bankrupt. There's pandemics. There's, rate environments. There's a lot of stresses that come on. So, it's not just simply the process of collecting cash and remitting it to the parties that are due that money, or doing the taxes, doing the insurance. It is a confluence of a lot of different moving pieces. And, Lonnie, I think one of the really important things to keep in mind is that 10 times out of 10, the servicer is a third party to the loan documents, to the borrower relationships, to the origination of those loans. So we are learning about that borrower, the specifics of their property, their tenant issues on the fly, right? The loan's closed, we've got it. We're not part of that original process. So I think that's one of the really unique factors. Respectfully, it's very easy for people to lose sight of, who are investors or other parts of the market, because they're not privy to that part. But all servicers are third parties to these documents and to these borrowers, and that's a very unique factor to what we do.
Yeah, especially when you're brought into a situation that's already, by definition, distressed or challenged, and you're trying to get up to speed on understanding who the borrower is, the property, and also try to find a resolution. Maybe just give us some color, like what does that process actually look like? I mean, how are you guys doing that?
So before we even get into the stress, I would tell you, when the loan closes into a securitization, conduit securitization, for example, it's not as if that borrower and the property are waiting behind a start line so they can begin operating, right? Deal closes are going, like, they're operating before. So even before the securitization closes, the master servicer is generally serving as what we call an interim servicer. So interim from origination to actual securitization. And we're getting requests for reserve draws. That's generally one of the first things that you'll see. It's a reserve draw. Hey, I did this build out. I did some TIs. I need some LCs, whatever the case is. So you're starting to get those requests immediately while the loans are being boarded, right? Like, they may not even be all the way through QC. So the process of administering the loans goes very quickly. But moving down the cycle, and if you want to use the most common CMBS deal today, that's a 5-year securitization, right? Like, we're used to doing longer deals, 10 years, but as we've discussed, Lonnie, recently, right, a lot of those deals, the majority of deals now, are actually 5-year securitization. So the potential for stress comes quicker, obviously, because the deal is truncated roundly by 50%. So stress starts to show up in CRE, frankly, just like it does in other places in your life, right? You see signs before you actually recognize the problem. So it could be a trigger, a covenant trigger, a tenant trigger, a DSCR decline, cash flow deterioration, leasing disruption, liquidity issues from, the borrower sponsor level. Insurance is a big one right now that causes stress. Frequently you have properties that are otherwise performing fine, but there's a problem with their insurance coverage, be it carrier ratings or the type and total volume of coverage that's out there. So very rarely does the problem come up where it just shows up and here is the issue, maybe unless it's a maturity default, right? Hard date and that you miss it. It's usually a progression through triggers that gets you to a point where that actual default or transitional issue is there. So, across servicing, the master servicer, generally the surveillance teams that are inside master servicers, are identifying those issues, reviewing the loan documents, the PSA, the transaction history, and they're determining whether that matter could actually be resolved in master servicing, if it's within our bandwidth as the master, or if it needs to be sent across the transom, if you will, over to the special servicer. And, at that point, when it moves to special, the special will establish that factual baseline. How did we get here? What should have been happening? And what do we need to do to progress to go forward? Sometimes you can get in and out quickly. Sometimes it's a bounce. Sometimes it's a dead cat bounce, right? And it stays for quite a long time. But I think importantly, whether it's master servicing or special servicing, the important thing is not to rush to a conclusion. All the investors listening will say he's wrong, get there quickly. But the important thing is not to rush to a conclusion. It's to control the flow, get a handle on the information, preserve the main value, maintain compliance, and really create that realistic path to a resolution, whether it's in the master servicing side or the special servicing side.
Yeah, and I think that's something that's a unique distinction that people should, understand, is that you're trying to get to a resolution. People may argue or say you took a longer path or more circuitous path or whatever, but the objective is to try to maintain and, keep as much value as possible for the bondholders. And so you mentioned the PSA. For those that don't know what that is, pooling and servicing agreement, maybe give us a quick 30-second, 100-foot view of what that is, kind of what that means for a servicer.
Yeah. It's funny. We were just, prior to recording this, I was downstairs. We had a retirement event for an associate who's been here at Midland for 35 years. And one of the things that he mentioned when he was giving his soliloquy about what's changed is PSA started and they were, 50 pages, 75 pages. Now PSAs, TSAs can be, bordering 1,000 pages, right? They are compendium. So each loan has its own loan documents. If it is a participated loan or something that's got mezzanine loan or subordinate debt, there are intercreditor agreements, co-lender agreements that govern the relationship between the various pieces. All of those loans that are contributed to a securitization, a conduit securitization as an example, are subject to the PSA, the pooling and servicing agreement. So it's the rule book for the securitization. It sets forth a process, a procedure, and path, sometimes in minute specificity, often in broad kind of, fisheye lens view of, if this happens, then this is what you do. They started slim because, frankly, securitizations when they began were very narrow, myopic facilities that were more fixed, and there wasn't a lot of fungibility to it. It's evolved over time to hundreds and hundreds and hundreds of pages to take into account the flexibility that borrowers need, the transparency that investors need, the working paradigm that servicers and trustees and certificate administrators labor under. So everything's in there. They're, not incredibly straightforward. They are different from shelf to shelf, even though we're talking about the same things. You can get to the same point. It's different terms, different defined terms, different procedures. So that's one of the complications for servicers and for investors is, this shelf 2026 Series 1, okay, I got it. This is how I do it. New shelf 2026 Series 1, it's different, right? It's not night and day different, but small differences. It's like steering a boat or steering an airplane, right? If you're 1 degree off on the rudder, you're going to end up thousands of miles away from where you want to be. So those documents, all of them, are the lifeblood of the industry, and it takes a lot of work to get through them, understand them, and work with them. One other thing I'll say is, generally speaking, borrowers are not privy to the PSA, right? It is not a part of their loan package. It's not part of the loan. It's where the loan is sold to the trust. So that can often be a cause of friction and ambiguity and concern from borrowers is, what is this PSA thing you're referring to, and why is it impacting me?
It's amazing how things have changed. And we're going to talk, a little bit about things that have changed, maybe things that should change. But, I think that's in a microcosm, a pretty good example. Something that used to be 50 pages, it's now 1,000.
Yeah.
Look, we work and live in a dynamic marketplace, and, transparency and availability of data, it creates sometimes easier paths, but it also creates complexity sometimes that didn't exist before. And I think you've
Right.
articulated that. And so, you started out talking about, getting into this line of work in the great financial crisis. And here we are in 2026. We've had another pretty significant disruption. What do you think from a compare contrast perspective? Like, obviously, these are two different events that have been driven by different things, but
Sure.
where do you take GFC compared to today?
A big familiar point, and I think Lonnie, this will be familiar far after we're gone. It should be consistent, right? Is that leverage matters, right? Leverage matters. The more debt you put on, the harder it's going to be to resolve it when the gears grind to a halt. Same line, liquidity matters, right? Sponsor behavior matters, and frankly, sponsor behavior and proclivities will ultimately drive different outcomes on the property level and cash flow. So all of that feels very familiar, and I would contend, that that's something that will persist permanently. Like, that's just part of this industry. What feels different? I think the rate impact came on a heck of a lot quicker and is lingering like a bad cough. Maybe not the best analogy given the world we've come through, but it's lingering. So many loans are stressed in today's environment, even when the property is not fundamentally broken, right? When the property has durability, tenants, demand, there's still a high level of stress because of the rate impact. I think another difference, and this one is, it might seem bigger, but it's probably not as big, is the property type, like office, right? In prior bents, it was retail. During COVID, it was hotels and retail. But I think the difference here is, office has a truly structural demand issue in a lot of markets, right? I think you and I have talked about this before too, that when we think about office in our industry, we are immediately drawn to major markets, New York, LA, San Fran, Chicago, right? The big markets. And we've seen even more than green shoots, we've seen solvency in those markets. We've seen strong returns and good fundamentals taking over. But I think about where I'm sitting in suburban Kansas City, where a very large securitized office park that our building is part of is probably 60% occupied today. And it's going to mature in the next 3 years. And there are a lot of CMBS deals in Kansas City. I'm doing air quotes for those who are just listening. Right. There are a lot of deals like this in Kansas City. That's the structural demand issue that I think is really persistent. And like the bad cough on the rate, I think it's going to linger because the consumption pattern for office in these secondary suburban exurb markets is just fundamentally different. I think another difference is the volume of maturity-driven conversations is a heck of a lot higher. And I think that's a good thing, right? I think sponsors, borrowers, master servicers are better about getting in front of specials, DCHs, direct and certificate holders, quicker than have been in the past, because the realization that in a lot of cases, extensions are going to be the best option. And that's a conversation that needs to be had soon, well in advance to be better prepared. And then I guess maybe one final familiarity, and I'd say this one for last because I think it ties into the top. This will be the case forever. It's servicing matters. Right? It absolutely matters. All of those differences I just gave you articulate operational problems at a property level, a debt level, facility level, trust level, and servicing is the consistency to navigate those problems, right? Having best-in-class servicing makes a real difference. And the professionals working on it in this market and all the various roles in servicing, master, primary, and special, are very quietly going about the way of ensuring that the familiar doesn't get completely overtaken by the different. And that's something I want your listeners to take away, is that you asked earlier, like, where does servicing sit in the paradigm? This is one of the crucial things for servicing. It really matters, and it always will.
Yeah, I think that's a great point, and I agree with you. And you don't necessarily see or value some of these things until you have to, right? It's just like operational chops of a GP on a property doesn't really matter until interest rates go up and their floating rate debt has a cap that expires, and you got to see how they can actually lease apartment buildings. Like, then it matters. And to your point on the servicing, it's the same thing. Like, you guys are the day-to-day. I mean, you're servicing the deals every day, and if you're not on your game, it creates downstream problems for everybody. And we've heard a lot recently that on new deals that are being underwritten, like sponsor quality, operational experience matters significantly more than it did pre-crisis, this most recent disruption. And I would argue the same for servicing, right? Like you guys have been there, seen that, done that. What are some nuanced things that experience and expertise would bring to the table from a servicer perspective, whereas maybe a non-traditional, maybe new entrant, someone else that just hasn't seen the cycles, where are they going to maybe miss and you guys not, et cetera?
That's a great question. And especially in the market we're in today, where there's, just from the servicing side, in terms of the number of servicers out there, right? There's a growing number of servicers, typically in the primary and special servicing place. There are new entrants to the master servicing side as well. Fewer, obviously, because it's a completely different type of business. So the nature of your servicer's platform experience and paradigm matters. Like just to put it on scale, like right now, as of the end of May, Midland's servicing portfolio, so master and primary servicing portfolio, was about 20,000 loans, roundly about 514 billion in balances. The biggest chunk of that is, of course, CMBS, about 13,000 loans and about 315 billion in balances. But there's a lot of diversity in the book too, right? There's an ABS book of about 77 billion, a balance sheet non-secured, so lenders, bank lenders, life companies, things like that. That's about 36 billion, and a very sneakily quiet SFR, single-family residential rental portfolio of about 50 billion, 870 or so loans. But interestingly, 240,000 properties in that SFR portfolio. So that's the kind of scale which I think gets to the point that you're driving me to, of how does experience matter, right? And why does having that kind of history matter, right? So I brought up the diversification of the portfolio to drive to that point that we are servicing a lot of different kinds of loans and a lot of different structures. And we have expertise across all markets in the U.S. and North America. And we work with borrowers from the biggest institutional names to the smallest mom and pop. In the SFR portfolio, you've got maybe Dave and Lonnie go out and buy 5 rentals and get a loan on it, and that could be in the SFR portfolio. So it's important to know that the servicer is able to work up and down the stack, not only a capital stack and a loan structure, but in terms of dealing with borrowers. You have to know how to work with borrowers, to have difficult conversations. And again, going back to the gentleman who just had his retirement event downstairs, right? He pointed out to our group, you need to be able to empathize with borrowers, with sponsors, but you can't make their problems your customers' problems, right? Because our customer is the trust, the lender, the balance sheet lender, whoever it is. And having a large, diverse portfolio that's evolved over time has provided our teams the opportunity to work through a lot of things. And we've worked through some even crazier things, Lonnie. Like we did a portfolio before COVID where we partnered with the NCUA, right, which is like the FDIC for credit unions. And we took on a portfolio of multiple billions of dollars secured by taxi cab medallions. Great learning experience. Probably not something we'd go after again, but tremendous learning experience for a lot of people. So I really think that's one of the important things when you're looking at a servicer is, I hear your scope of services. I understand you say what you can do for me, but what have you done? Like, because to the point, the proof is in the pudding, right? And I think at Midland, you can see we've maintained a very diverse portfolio, and it's always been part of our ecosystem to do that.
Yeah, I mean, I think just the scale of that is impressive. And as you mentioned, just having kind of your hands in all those different things at once. And, I think we underestimate, for folks that are not sitting on the servicer side, just how much work actually goes into that. I mean, when you start throwing out numbers like 20,000 loans and hundreds of thousands of properties. I mean, even if everything goes perfect, right, you're still processing huge amounts of data. Yep. And we know things don't go perfect. And I wanted to circle back a little bit on the office stuff because, I agree with you on the suburban kind of this Class B office challenge that's going to be persistent. And I also agree that the extend model is probably the best option. Where I get a little bit, like some friction in my mind is, in order for these offices to really survive on a go-forward basis, I think there has to be a reset in the cost basis. And that's uncomfortable for everyone. The extension model doesn't, it just prolongs getting to that point, because an office building that's 60% occupied at a trade from 2019, 20, or 2021 is not going to be able to cash flow. But if it sells for 40 cents on the dollar, it may be able to cash flow at 60% occupancy. So, how do you balance that dynamic of extension maybe works for some in terms of value recreation and like there's a hope at the end of the tunnel, but for a large majority, like you're probably just extending into something where the value never recovers.
Yeah. So what you're talking about really gets to I think the special servicer's credo that at the end, your first loss is your best loss, right? And generally speaking, once you get through all your derivatives and maybe you've done a multi-year extension and with some options or something like that, there's a better than average chance that, I don't want to overstate it and pour too much water on the hard work specials are doing on extensions, but there's a decent chance that that first loss could have been the best loss, right? But that gets to your point, Lottie, that first loss predicates a value reset on that property, on the bonds, on the deal. And that's the difficult pill to swallow is who's going to be the one that waves through the 40% decline in value and the resultant impact on the trust. So that is where the value of your special and the partnership between the special and the directing certificate holder really comes to bear fruit, right? That they have to be able to collectively work for the benefit of all bondholders, to be technical, right? To be specific. It's not just to the benefit of the DCH. We, the specialists, to the benefit of all bondholders, and really do the hard work on identifying, okay, if we're going to extend, how do we avoid that path that you just described, which is the extension to nothing? Generally, that's predicated on a significant and ongoing contribution of capital, right? So when we see sponsors who are willing to pay down the loan a bit, recapitalize the reserves in the escrow accounts, really engage in the leasing effort and look for creative solutions, you feel good that you're not doing an extension to nowhere. But all of that can be undone by circumstances that are out of everyone's control. I think there have been some really creative solutions with office deals in the past 12 months by various special servicers. Several in Chicago, at least one big one in Chicago. And I think there's more coming. But again, that goes back to the paradigm I was talking about earlier, Lonnie, that those are, major markets. When you're trying to do the one that you can see out of my window right now, your paradigm is just different, right? And those are the ones where it just becomes a long slog. And ultimately, it's up to the special to say, we've reached the point of anything beyond here is the point of no return, and we've got to liquidate this thing. That's where you come into a classic conundrum, if you will, in the servicing structure. And just to be blunt, if you have a third-party servicer, like, for example, Midland is a third-party servicer, we don't own any bonds, right? If you have a third-party servicer and we ultimately conclude that the best action is something that's going to wipe out the directing certificate holder, the directing certificate holder has the option to replace us with someone else, right? So I think that's one of the conundra that is endemic to the structure that we have. And by all rights, those investors have that right. They bought those bonds, they own the first loss, and it's well within their purview to say, this isn't right. But you go back to the first loss is your best loss. Those are the kind of scenarios where I think you see that come out of the laundry. So I know that was kind of long-winded. I don't know if I got to what you're actually trying to get me to.
Yeah, no, that's perfect. I mean, I think we see the headlines and we can do the math. But, to your point, if a sponsor is willing to put additional capital into a deal, significant additional capital, like why would you force the issue today if you can hope for a better tomorrow?
Right.
But in some instances, to your point, if you're in Kansas City, are the dynamics of that market going to shift so much in a 24-month extension?
I don't think you should expect to see those kind of deals here, right? Because of the fact the dynamic of the market isn't going to change, is not going to move that quickly or maybe ever. And it may only go south. So, in these type of markets, I don't think you should expect to see that. And, I think the issue that plagues us here, obviously we've got the office sector issue. I think one of the issues that really plagues, I know it is, that plagues CMBS investors on this, we talk about it a lot, is the lack of transparency around what the special services are doing. And it's not something like anyone that's ever heard me on a panel knows, right? This is not something that services are doing to intentionally confuse the investor market. There is just no way that special servicers can share detailed information about the investment, the mod strategy, the REO strategy on an interim basis. Those facts can only be shared once the deal is done, because otherwise it upsets the balance that the trust, the lender, the special holds in the deal. And I appreciate the position that investors find themselves in, but this is a tale as old as CMBS. This has been the case forever. It's nothing new. I just think it's a little more poignant right now because you're dealing with it on large SASB deals in particular and big office deals where there's a value question, as we've been talking about.
Yeah, I agree with you. I think because something else to kind of like piggyback on, you mentioned the shift from 10-year to 5-year terms. As a servicer, I mean, that probably isn't ideal in the sense that if and when you have difficulties, you just have a much more consolidated window to try to get those things resolved. I mean, I think one of the benefits of 10-year term is if something goes awry midstream, you still have 4 or 5 years to try to get to resolution. Whereas in 5 years, it's just, things don't move that quickly. I mean, is that a real concern? Is that a real challenge?
I mean, I think it is. I mean, I think the reality is specials are going to take obviously whatever comes in the door. They have to. That's what we do. But there's a couple things in the 5-year deals that accentuate the point you're making, right? The first you've already said is the time frame is shorter. You're going to get to refinance considerations much more quickly than you would, and you don't have time to write out cycles. Imagine if the entire market were 5-year deals in March of 2020. Right? Like, that's the best example I can give you. CMBS is dead forever. Like, imagine the headlines, right? It would be terrible. So, and it was already pretty bad, but that exposure to a defined, rate stress or market event is much bigger. Second thing, no amortization, right? And there's just no point in putting amortization in a 5-year deal. You don't get any benefit for it. The cash is better used elsewhere in the structure. And, that just, as I said earlier, leverage matters, right? The more leverage you have out, the more complicated it gets. So incrementally, your workouts become more challenging and your refi becomes more challenging because 5-year deal, rates haven't gone anywhere but up or flat. You haven't amortized your loan, and whatever credit issues have happened in your 30, 40, 50 loans in your CMBS pool. So that's a problem. From a master servicing side, the term obviously matters. The longer the deals stay in, from a profitability perspective, it's more profitable. From operating the deals and managing them, the requests and the asset management volumes, I can't say that they are 2x higher because the deal is 2x shorter, but they intuitively come in, more rapidly just by force of timing in that the deal is half. So it puts a bigger demand on the system. And I definitely agree, Lottie, that it causes issues on the back end. And we're almost there, right? Like we're at 26. I mean, the 5 years really became big fad trend in like 22, right? Mm-hmm. So, we'll see. Maybe I'll be proven wrong. I'm proven wrong regularly. I don't think this will be one where I'm proven wrong.
So let's talk a little bit about the split between conduit issuance, SASB issuance, and ramifications of that. I mean, for those that don't know, I mean, we've covered it on our regular weekly show, but over the last couple of years, we've seen about 70% of total CMBS origination has been SASB with an ever-shrinking conduit market. Is that something that persists? Does that create problems? What's your perspective?
Yeah, it's definitely persisting this year. In fact, I think it's probably getting more pronounced. As of the CREFC conference, or as of early June, I think there have been mid to high teens number of conduit deals done for like a $17 billion balance. And SASB is obviously way, way, way above that. The other factor that's in there that I think we have to add into this discussion, Lonnie, is CLO issuance, right? And because CLO issuance this year is already outstripping conduit CMBS issuance, and all of those factors challenge the viability of conduits. I'm not saying I think conduits are going away. I will say I think a lot of people prefer a 10-year conduit, but a lot of people don't. So that's, I think, why we're in this paradigm. SASB, by its very nature, when it started, was generally above 400 to above $500 million in balance. Now you see some SASBs that aren't SASBs. They're 250 million, right? These should be participated conduit loans. And yes, I am the servicer that just said you should participate a loan, but it's not a true SASB. And is that because they can't get the execution they want in conduit, or that it's just that much better in SASB? I can't answer that because I'm not on that side, but we see a significant number of those smaller SASBs, right? The SASBs that are really big are generally data and some bigger office and retail deals. But we do see a lot of that small stuff. And then the shift to CLO has been pretty pronounced, right? Those structures allow for more variability in what's going on at the property, right? It's a floating rate deal. You can bring transitional deals in. You can work your way through an evolution. I think in the ideal world, CLO would mature into a 10-year conduit and the cycle would go like that, but it's not necessarily working like that. So look, I hold no aspirations that the conduit market is going to, shake off the dust and, exceed where it was last year. I think, getting to where we were last year would be an achievement. And it does point to the fact that, there are other methods of executing. There are other forms of debt that can be taken out, other ways to go that borrowers are finding. And that what that means for the long-term viability of conduit, I'm not 100% sure, but I know right now it's certainly not as robust as most would like it to be.
We're seeing that real time. The CLO issuance is roughly 2.5 times out of conduit, and that short term nature of it. I mean, those are sometimes 24 to 36 month initial terms, and they have some extension options, but it gives a lot more flexibility to the borrower than what you're seeing even in the 5-year conduit. So let's transition a little bit here to you have a magic wand. You've been in this business a very long time. You've seen the ups and downs. You've seen the things change and haven't changed. What are some things that could make this part of the process smoother, better, that could maybe dispel some of the narrative that you talked about on the front end where people just don't truly understand what a servicer does? Like, is it a messaging issue, or are there things that need to structurally change? What does that look like?
Yeah, that's a fun question. And I don't think any servicer would operate under the notion that at some point everybody's going to understand what we do and how we do it, right? Because it doesn't matter until it matters, right? It doesn't matter until it has to be there. Otherwise, it's like gravity. You wake up and it's just there, right? You're not floating in the air, so things are good. But I think there are some things. I think borrowers are often surprised by how document-driven and process-driven the system is, right? Like maybe it's their first CMBS loan. That's generally the exception these days, but maybe they're newer to CMBS, and the commercial answer that works for the borrower still has to fit the PSA, the loan documents, the investor rights, and the servicing standard, right? So while the borrower may come and say, this makes perfect sense, it might not actually make perfect sense in the light of the structure. So I think borrowers are caught off guard by that. And, since they're not privy to the PSA, I think that's incumbent on the originators to make sure that their borrowers understand what's going to happen to the loan and where it's going to go, and that it's subject to other things. And the originators can share with them, this is what happens in servicing, right? Like, I know they're not going to give them a whole playbook, but they can do a little bit more, I think, on that side to help educate. I think investors, they continue to be unhappy with the lack of transparency that I talked about, but I think they're often surprised by the number of operational steps behind a mod, an extension, a workout, an REO, right? Because again, it seems like, oh, you're gonna foreclose this property, just do it, just get it, let's go on and sell it. It couldn't be more difficult than that, right? So I think that surprises some people and drives in, the timing variable, right? Timing catches people off guard, whether it's in appraisals or moving cash or, legal milestones or, the process and the documents. I think that those types of things kind of catch people off guard and complicate the process. So how do people navigate it better? What can we do to help get through the process better? I think uniformly, the best borrowers communicate early. And I mentioned earlier, Lonnie, that I think this is happening more now. We see it more now, but communicate early, provide complete information. Let's acknowledge the real issue, right? Let's get to the heart of the matter instead of trying to bury the lead. And to state the obvious, bring your sack of cash, your proverbial bag of cash, and a plan. At least bring a plan, and we'll jointly figure out the cash. because that transparency builds credibility, right? It builds a better path to execution. And that's ultimately, I think the best thing that we can do is foster that strong communication. I'll put in one more plug before we move to the next thing, that I do believe that the state of servicing in our industry is better today than it's ever been. All masters and all specials do a tremendous amount of work communicating with each other. We have forever. It really picked up during COVID when all of us kind of, doubled and tripled the effort and made sure that we were timely communicating and executing and leveraging as much as we could in the documents. And the good thing is it's persisted. It's lasted. There is great dialogue. Masters meet with specials on a regular basis at conferences, on a bespoke basis. And that is a net positive. That better communication and operational transparency is good for everyone in the process.
Yeah, I mean, we've talked to a lot of folks, and I think we align with that. I mean, I think the early communication, transparency, just the way things operate today are significantly better than they've ever been, and I think that'll continue as technology evolves and people can communicate in ways and share documents and information and insights, and I think that part of the equation is really good, and we'll just get better. So I wanted to circle back. We'll kind of wrap up here with maybe last two questions. You and I were able to catch up at CREFC here in June in New York. And, one of the takeaways we had as a group was it just seemed like the talk track in June was much more cautious or moderated than it was maybe in January. Like coming out of January, it felt like everyone was on fire. The optimism was overflowing. Attendance was record setting. Like everyone has capital. They're going to deploy it. It's going to be great. Oh, by the way, we got this little conflict that's going to pop up in Iran and oil prices are going to go through the roof and, things are going to change. And so do you think that's a fair characterization where people really just kind of beaten down a little bit with some of the macro stuff and so the optimism faded? Or did you maybe have a different perspective from this June's conference and maybe take that forward and say, what do you think we'll see come this next January?
Yeah, so I do feel in general that the optimism was more subdued, in particular after the Knicks lost that one game. People thought the whole world was over, but just like the Knicks proved, the sun always rises and you can come back from even one staggering defeat. But seriously, I do so I don't know if it was actually truly more subdued or just more channeled and more focused on specific things. This one deal, this default that we're working on, a new lending platform, a new CLO initiative, things like that. So I think there was still plenty of optimism. I think people were just a little more focused on what they were optimistic about. I think in Miami, everyone was just, way, to your point, over their skis optimistic. Like it just felt like everything was coming together right and we're going to hit the ground running, and the projections for conduit issuance and a whole bunch of other things were there. Then the conduits didn't go as robust because they got through their year-end deals that carried over into January, and then there was a bit of a lull. Then data came in and you had all these 2 billion plus data deals that injected a lot of new volume into the SASB space, and then all the concerns around data are more well understood, and that volume still continues to go up, and then CLOs are picking up. So it was, a bunch of different EKG lines going up and down simultaneously. And I think the noise just became like tinnitus, right? It was the ringing in people's ears. It was just going on. Here, I think people really focused in on the things they were excited about. We had a lot of great meetings at Midland with investors and partners in the market, lenders and issuers, and have identified, green shoots and beyond for things to do. So I do think there's definitely things there. I think people just kind of reined it in and maybe did it more in their own privacy. I think the one thing that was really unique about CREFC, though, was a lot fewer bank parties, right? That's always kind of the canary in the coal mine. When the banks stop doing parties, you're like, oh boy, pack it up. We're done. So there were a lot fewer of those. And that I don't know if you heard that conversation, like, but there were people like, hey, have you noticed there's a lot fewer bank parties this year? Like, what does that mean for the state of the industry?
It is funny how that's kind of an indication, but I do think people have come to know that as an indicator. If there's less parties, it doesn't send us a signal of confidence. But
No.
maybe that'll be rectified come January. I mean, I think the Miami conference is just set up to be more conducive for that, obviously. New York is a tough place. So I said two more questions. I'm going to add one more. So on the data center stuff and data stuff, I have to talk about that a little bit. We can't have a podcast and not talk about that. You can't have a panel and not talk about it. You can't, do anything without learning about data centers. Does that create some inherent risks that, are, one, the size and scope of these are just significantly larger than what we've seen traditionally? Two, there's a lot of questions around if this is a pure play real estate or something else.
Yeah.
Three, like there's a lot of concentration with tenants and other things. Like, give me your thoughts on this.
Yeah, so it is almost replaced AI, ironically, as the topic that you can't go somewhere without having a conversation about, which the ironic part is, one feeds the other. But I think data centers as a distinct risk category, really predicate some explicit documentation and servicing practices, right? Like the revenue concentration and exposure vis-a-vis tenants, vis-a-vis hyperscalers, the nature of the technology, the demand, regulatory changes, the development pipeline. In some places it's grinding to a halt, and others it's speeding up quite substantially. The opaque nature of the collateral. Is it the building? Is it the lease? Is it ABS, CMBS? Project finance, right? Initially, there was some gaming of the system, I think, probably going on to find the best execution, air quotes again. I think as an industry, we've worked through, I think the rating agencies have done a good job of working through that arbitrage that could happen on the front end. And I think as best we can, we understand the collateral. But to me, Lonnie, it comes down to the collateral ultimately and the technology and the collateral, right? We don't know. Is the next evolution of it that the space need gets bigger because the chips and the setups get larger and have a bigger requirement for water and power and cooling? Or does it go the opposite direction and get smaller, which intuitively you would expect it to, right? Being the technology experts we are. And then you have superfluous space that, what are you going to do with it then, right? You've already taken the farmland and made it a data center. So that conundrum about the collateral and where it goes, bigger, smaller, and what happens as a result. And then power. I mean, not to state the obvious, but I've had this conversation a couple times, but I believe based on my unofficial research that we're not that far off from self-contained nuclear power in some of these places. And maybe a good parting thought on this is, can you imagine a world where a loan secured by a data center that has a nuclear reactor goes in default and a special servicer is in charge of that? I mean, don't worry. We know what we're doing, but that is a crazy paradigm to think of. And it could never happen, but maybe it could. So all of those factors, look, at the end of it, it goes back to the very beginning of our conversation today. The basis is the same. The basics, I should say, are the same. It's cash collection, it's monitoring the collateral, and it's managing with the borrower, the sponsor, their business needs through that real estate. The challenge here is the business need. Who knows what it is and what happens there? But more power to data. Let's go.
I think that'll be a pretty interesting conversation when you go from taxi medallions to nuclear reactors. Right. That'll be pretty impressive on the resume. Yeah. All right, so to wrap up here, I'm glad we're laughing here because it's kind of a lighthearted softball question at the end. But at CREFC, you were able to do the interview with Colin Jost.
Yep.
How did that come about? Give us your insights on what that experience was like. I think for everyone in attendance, it was incredible. One, he was really great. Two, you did a great job keeping things moving. Give us the inside info on that deal.
Well, thank you. First of all, I mean, it was a ton of fun. I met our summer interns a couple weeks ago, and they asked one of the questions in the room was, "What's one of the career moments you've had?" And I cited that one. It was a ton of fun. CREFC does a great job of working with the Speakers Bureau to select those speakers. And as you could tell from that, when he and I sat down at the update desk, we have a pretty deep history with SNL, right? I mean, we had Colin Quinn, we obviously had Colin Jost, and Keenan Thompson. And I have to give a ton of credit here to MJ Potoff from Morningstar DBRS, who's runs planning and events for CREFC. And she did a great job of lobbying for me to be the board member who had the opportunity and the privilege to sit with Colin. So because of her effort to do that, I was given the chance. And from there, it became real easy. I read his memoir. I think I listened to or watched like 5 to 8 of his most recent podcasts. or television interviews. And I mean, I had a stack of questions. I think we got through like 2 of my questions and then it just turned into riffing. But it felt like a really good, organic, kind of free-flowing conversation. And I got to tell you, when I sat down up there at that desk and kind of looked to my right, and they did it on purpose. They built an update desk so it would feel like Saturday Night Live. I think I might have even said it when I sat down. Like, I'm sitting at the update desk with Colin Jost. I'm sitting in the Michael Chase seat. Like, this is phenomenal. So it was a lot of fun. He's a great guy, just as funny backstage and natural. Showed up on a city bike. He literally rode a city bike. And all the keynote speakers always, they have like a rider of, I need this stuff in the green room. And he had the oddest rider. He had a bottle of Casamigos, some protein bars, bitters, ginger beer, some regular beer. It was the strangest thing. And I asked him while he was sitting back there signing books, what's up with this bar? Like, what is this? And he's like, honestly, sometimes we just put random things on there just for the purpose of making people have this conversation. So when he was done, everyone, the people come back and meet him and get their book and chat and giggle for a little bit. And then he's taken off. So I was saying goodbye to him. And I leaned into him. I said, Colin, you got to take something from this. Like, you can't not take something. He was like, seriously? I was like, yeah, they put a lot of effort into bringing this. So he took 3 protein bars and shoved them in his suit coat pocket, grabbed the bottle of Casamigos and said, I'm just going to stick this in the front of the city bike and ride my way back to our apartment. So, and power bars or for protein bars for dinner at the Jost house that night.
Well, that's incredible. And the interview was incredible at CREFC, and this one has been equally as incredible, David. So thank you so much for joining us today. We can feel your passion through the microphone, through the screen, and it's clear you are an expert in this industry. So we really thank you for sharing all your knowledge with our listeners. Before we let you go, can you just tell our listeners how they can get in touch with you or learn more about your business or your firm if they have questions or comments?
Yeah, sure. Thank you. So anyone who wants to reach out and chat, email is really easy. It's just david.harrison@pnc.com. You can go to pnc.com and go to the PNC real estate section, learn all about PNC real estate, and the Midland page is on there as well. So please reach out with questions, compliments, and complaints. I can give you a different email to reach out to, but happy to talk to anyone. Thank you.
Well, thank you so much. This has been an incredible episode, and we'll check in again at the January CREFC and see how things are going. So with that, we'll close this special podcast. Thank you, David, for joining us today. Join us later this week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com. Until then, visit trepp.com for more info and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.